in determining whether you succeed, there's more to it than intellect and energy, and I'd like to talk for just a second about that. In fact, there was a fellow that Pete Kiewit in Omaha used to say that he looked for three things in hiring people. He looked for integrity, intelligence, and energy, and he said if the person didn't have the first two, that the latter two would kill him. Because if they don't have integrity, you want them dumb and lazy. You don't want them smart and energetic. And I really like to talk about that first one, because we know you've got the second two. And to play along with me in a little game for just a second, in terms of thinking about that question. You've all been here, I guess almost all of your second-year MBAs, and you've gotten to know your classmates. And think for a moment that I granted you the right to buy 10% of one of your classmates for the rest of his or her lifetime. Now you can't pick one with a rich father. That doesn't count. I mean, you've got to pick somebody who's going to do it on their own merit. And I gave you an hour to think about it. Which one are you going to pick among all your classmates as for the one you want to own 10% of for the rest of their lifetime? Are you going to give them an IQ test? Pick the one with the highest IQ? I doubt it. Are you going to pick the one with the best grades? I doubt it. You're not even going to pick the most energetic one necessarily. You're the one that displays the most initiative. But you're going to start looking for qualitative factors in addition to, because everybody's got enough brain here and enough energy. And I would say that if you thought about it for an hour and decided who you're going to place that bet on, you'd probably pick the one who you responded the best to, because the one that was going to have the leadership qualities, the one that was going to be able to get other people to carry out their interests. And that would be the person who was generous and honest and who gave credit to other people even for their own ideas, all kinds of qualities like that. And you could write down those qualities that you admire in this other person, whoever you admire most in the class. And then I would throw in a hooker. I would say as part of owning 10% of this person, you had to agree to go short 10% of somebody else in the class. That's more fun, isn't it? And you think, well, now who do I want to go short of? And again, you wouldn't pick the person with the lowest IQ you would start thinking about the person really who turned you off for one reason or another. I mean, they had various qualities, quite apart from their academic achievement, but they had various qualities. In the end, you shouldn't really want to be around them, and other people didn't want to be around them. And what were the qualities that lead to that? Well, there'd be a whole bunch of things, but it's the person who's egotistical, the person who's greedy, the person who's slightly dishonest, cuts corners, all of these qualities. And you could write those down on the right-hand side of the page. And when you look at that, I don't know which one I'm using. Can you hear me okay with this? Yeah, fine. Yeah.
Your microphone on the side. Just needs to come back up.
What do I do with it?
It just came loose.
Oh, it just came loose. Okay. You can see why I avoid technology. Chewing gum is about as far as I get. As you looked at those qualities on the left and right-hand side, there's one interesting thing about them. It's not the ability to throw a football 60 yards. It's not the ability to run the 100-yard dash in 9.3. It's not being the best-looking person in the class. They're all qualities that if you really want to have the ones on the left-hand side, you can have them. I mean, they're qualities of behavior, temperament, character that are achievable. They're not forbidden to anybody in this group. And if you look at the qualities on the right-hand side, the ones that you find turn you off in other people, there's not a quality there that you have to have. If you have it, you can get rid of it, and you can get rid of it a lot easier at your age than you can at my age, because most behavior is habitual, and they say the chains of habit are too light to be felt until they're too heavy to be broken. And there's no question about it. I see people with these self-destructive behavior patterns at my age or even 10 or 20 years younger, and they really are entrapped by them. They go around and they do things that turn off other people right and left, and they don't need to be that way, but by a certain point they get so they can hardly change it. But at your age, you can have any habits, any patterns of behavior that you wish. It's simply a question of which you decide, and why not decide the ones that, I mean, if you like, Ben Graham did this, and Ben Franklin did it before him, but Ben Graham in his low teens looked around and he looked at the people he admired, and he said, I want to be admired, so why don't I just behave like them? And he found there was nothing impossible about behaving like them. And similarly, he did the same thing on the reverse side in terms of getting rid of those qualities. So I would suggest that if you write those qualities down and think about them a little while and make them habitual, you will be the one that you want to buy 10% of when you get all through. And the beauty of it is you already own 100%. You're stuck with it, so you might as well be that person as somebody else. Well, that's...
Hello, Mr. Buffett. I got two short questions. One is, how do you find intrinsic value in a company?
Well, intrinsic value is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments, it says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change, but the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously, and you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question about how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business because that's my approach to it. I look at it and say, what will come out of this business and when? And what you really like, of course, is them to be able to use the money they earn and earn higher returns on it as you go along. I mean, Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the businesses we own increases. We can compound it internally, but the real question is, Berkshire selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock.
Thoughts about Japan?
My thoughts about Japan? I'm not a macro guy. Now, I say to myself, Berkshire Hathaway can borrow money for 10 years at 1% in Japan now. 1%. And I say to myself, gee, I took Graham's class 45 years ago, and I've been working hard at this thing all my life. Maybe I can earn more than 1%, if I really work hard at it. 1% annually. It doesn't seem impossible, does it? So I wouldn't want to get involved in currency risk, so I'd have to do it in something that was yen denominated. So I have to be in Japanese real estate or a Japanese business or something of the sort, and all I have to do is beat 1%. And that's all the money's going to cost me, and I can get it for 10 years. So far, I haven't found anything. It's kind of interesting. The Japanese companies earn very low returns on equity, and they have a bunch of businesses that earn 4%, 5%, 6% on equity, and it's very hard to earn a lot as an investor when the business you're in doesn't earn very much money. Now some people do it. In fact, I've got a friend, Walter Schloss, who worked with Graham at the same time I did, and it was the first way I went at stocks, to buy stocks selling way below working capital, very cheap quantitative stocks. I call it the cigar butt approach to investing, is that you walk down the street and you look around for a cigar butt someplace, and Finally you see one, and it's soggy and kind of repulsive, but there's one puff left in it. So you pick it up, and the puff is free. I mean, it's a cigar butt stock. I mean, you get one free puff out of it, and then you throw it away, and you walk down the street and try and find another one. I mean, it's not elegant, but it works. You know, if you're looking for a free puff, it works. Those are low-return businesses. But time is the friend of the wonderful business. It's the enemy of the lousy business. If you're in a lousy business for a long time, you're going to get a lousy result, even if you buy it cheap. If you're in a wonderful business for a long time, even if you pay a little too much going in, you're going to get a wonderful result if you stay in a long time. I find very few wonderful businesses in Japan at present now. They may change the culture in some way so that managements get more stockholder responsive over there and returns are higher. But at the present time, you'll find a very lot of low-return businesses, and that was true even when the Japanese economy was booming. I mean, it's amazing. They had an incredible market without incredible companies. They were incredible in terms of doing a lot of business, but they weren't incredible in terms of the return on equity that they achieved. And that finally caught up with them. So we have so far done nothing there, but as long as money's 1%, I'll keep looking. I mean,
if you look at our annual report, which is on the internet at our homepage, BERKSHIREHathaway.com, you'll see something in the back called the Economic Principles of Berkshire. And you will see, which I believe in setting out for my partners. They are my partners. I don't look at them as shareholders. I look at them as partners. They're going to be my partners for life. So I want to tell them how I think. And if they don't agree with the way I think, that's fine, but I don't want them to be disappointed in me. You know? So I lay out there, and I say, in terms of our wholly owned businesses, we're not going to sell no matter how much anybody offers us for them. I mean, if somebody offers us 3 times what something is worth at See's Candy, the Buffalo News, Borsheim's, whatever it may be, we're not going to sell it. I may be wrong in having that approach. I know I'm not wrong if I owned 100% of Berkshire, because that's the way I want to live my life. I've got all the money I could possibly need. You know, it just amounts to a change in the newspaper story on my obituary and the amount of money that the foundation has. And to break off relationships with people I like and people that have joined me because they think it's a permanent home, to do that simply because somebody waves a big check at me would be like selling one of my children because somebody waved a big check. So I won't do that. And I want to tell my partners I won't do it so that they're not disappointed in me. More and more, with certain stocks, we've got that approach. Now, if we were chronically short of funds and had all kinds of opportunities coming, we might have a somewhat different approach. But our inclination is not to sell things unless we get really discouraged perhaps with the management, or we think the economic characteristics of the business change in a big way. I mean, and that happens. So, but we're not going to sell simply because it looks too high, in all likelihood. I mean, you can't make that 100%, but that's the principle under which we're operating. We're generating right now $5 billion of cash a year at least. So it's $100 million every week. And, you know, just not, we've been talking here half an hour and I haven't done a damn thing. It's, you know, the real question is how do you put it out intelligently? And if we were selling things, it'd be just that much more. So there may come a time when that would change. But we want to, and I have partners, shareholders, partners, who would say, if you can get 3 times what See's Candy's worth, why don't you sell it? And that's why I want to be sure before they come in, they know how I think on that. I mean, they're entitled to know that. You really want, think for a minute, you know, if you're going to get married, and you want a marriage that's going to last, not necessarily the happiest marriage, you know, or one that Martha Stewart will talk about or anything, but you want a marriage that's going to last. What quality do you look for in a spouse? One quality. Do you look for brains? Do you look for humor? Do you look for character? Do you look for beauty? No. You look for low expectations. I mean, that is the marriage that's going to last. Both have low expectations. I mean, and I want my partners to be on the low side on expectations coming in, because I want the marriage to last. It's a financial marriage when they join me at Berkshire, and I don't want them to think I'm going to do things that I'm not going to do. So that's our guiding principle. The advice is all free, and your marital advice, everything else. Next.
You were rumored to be one of the rescue buyers of long-term capital. What was the play there? What did you see?
Well, there's a story in the current Fortune magazine, one has Rupert Murdoch's picture on the cover that tells the whole story of our involvement. It's kind of an interesting story because it's a long story, so I won't go into all the background of it, but I got the really serious call about long-term capital probably, 4 weeks ago this Friday, whenever it was. It was my granddaughter. I got it in mid-afternoon, and my granddaughter was having her birthday party that evening, and then I was flying that night to Seattle to go on a 12-day trip with Gates to Alaska in a private train, all kinds of things where I was really out of communication. But I got this call on a Friday afternoon saying that things were really getting serious there. I'd had some other calls before that the article gets into a few weeks earlier. I know those people, most of them pretty well. So a lot of them were at Solomon when I was there. And the place was imploding, and the Fed was sending people up that weekend. And so between that Friday and the following Wednesday, when the New York Fed, in effect, orchestrated a rescue effort, but without any federal money involved, I was quite active, but I was having this terrible time because we were sailing up through these canyons, which held no interest for me whatsoever, in Alaska, and the captain would say, you know, if we just steer over here, we might see some bears and whales. And I said, steer where you get a good satellite connection, because I want. So it was. In fact, there's a picture, unfortunately, where I've got my Old Faithfuls going off behind me, and I've got my back to it. I'm on the phone, which was the people in the group thought it was kind of funny the way I was working the phone. But we put in a bid on Wednesday morning. By then I was in Bozeman, Montana, and I talked to Bill McDonough, the head of the New York Fed, about 10 o'clock. They were having a meeting of the bankers at 10 o'clock that morning in New York, and I caught him. We actually delivered a message to him. He called me out there in Wyoming a little bit before 10 New York time, and we made a bid. It was because it was being done at a long distance and everything. It was really the outline of a bid, but in the end, it was a bid for $250 million, essentially for the net assets of. But we would have put in $3.75 billion on top of that, and it would have been $3 billion from Berkshire Hathaway, $700 million from AIG, and $300 million from Goldman Sachs. And we submitted that, but we put a very short time fuse on it, because when you're bidding on $100 billion worth of securities that are moving around, you don't want to leave a fixed price bid out there very long. Plus, we were worried about it getting shopped. In the end, the bankers made the deal, and but it was an interesting period. The whole long-term capital management, and I hope most of you are familiar with it, but the whole story is really fascinating, because if you take John Merriweather and Eric Rosenfeld, Larry Hillenbrand, Greg Hawkins, Victor Agani, the two Nobel Prize winners, Merton and Scholes, if you take the 16 of them, they probably have as high an average IQ as any 16 people working together in one business in the country, including at Microsoft or wherever you want to name. So an incredible amount of intellect in that room. Now you combine that with the fact that those 16 had extensive experience in the field they were operating. I mean, this was not a bunch of guys who had made their money, selling men's clothing and then all of a sudden went into the securities business or anything. They'd had in aggregate, the 16 had probably had 350 or 400 years of experience doing exactly what they were doing. And then you throw in the third factor, that most of them had virtually all of their very substantial net worths in the business. So they had their own money up, hundreds and hundreds of millions of dollars of their own money up, super high intellect, working in a field they knew, and essentially they went broke. And that to me is absolutely fascinating. I mean, if I ever write a book, it's going to be called Why Smart People Do Dumb Things. My partner says it should be autobiographical, but but this might be an interesting illustration. And these are perfectly decent guys. I respect them, and they helped me out when I had problems at Solomon, and so they're not bad people at all. But to make money they didn't have and didn't need, they risked what they did have and did need. And that's foolish. That is just plain foolish. It doesn't make any difference what your IQ is. If you risk something that is important to you for something that is unimportant to you, it just does not make any sense. I don't care whether the odds are 100 to 1 that you succeed or 1,000 to 1 that you succeed. If you hand me a gun with 1,000 chambers, 1,000,000 chambers in it, and there's a bullet in one chamber, and you said, put it up your temple, how much do you want to be paid to pull it once? I'm not going to pull it. You can name any sum you want, but it doesn't do anything for me on the upside. And I think the downside's fairly clear. So I'm not interested in that kind of a game. And yet people do it financially and without thinking about it very much. There was a great book. It wasn't a great book. It was a great title. There was a lousy book written once with a great title by Walter Gutman. The title was You Only Have to Get Rich Once. Now, that seems pretty fundamental, doesn't it? What difference if you've got $100 million at the start of the year and you're going to make 10% if you're unleveraged and 20% if you're leveraged 99 times out of 100? What difference does it make at the end of the year whether you've got 110 million or 120 million? It makes no difference at all. I mean, if you die at the end of the year, the guy that writes up the story may make a typo and he may say 110 even if he had 120. So you've got nothing at all. It makes absolutely no difference. It makes no difference to your family. It makes no difference to anything. And yet the downside, particularly managing other people's money, is not only losing all your money, but it's disgrace and humiliation and facing friends whose money you've lost and everything. I just can't imagine an equation that makes sense for. And yet 16 guys with very high IQs who are very decent people entered into that game. And I think it's madness, and it's produced by an over-reliance to some extent on things. Those guys would tell me back when I was at Solomon, that a 6 Sigma event wouldn't touch us, or a 7 Sigma event, but they were wrong. I mean, their history does not tell you the probabilities of future financial things happening, and they had a great reliance on mathematics, and they felt that the beta of the stock told you something about the risk of the stock. It doesn't tell you a damn thing about the risk of the stock, in my view. And Sigmas do not tell you about the risk of going broke, in my view, and maybe in their view now too. But I don't like to even use them as an example because they are. I mean, the same thing in a different way could happen to any of us probably. Yeah.
How should an investor evaluate owning shares of Berkshire Hathaway or Microsoft when they don't pay dividends to the investor?
Yeah. Well, the question with Berkshire Hathaway, the question was about evaluating Berkshire when it doesn't pay any dividends. And it won't pay any dividends either. It's a promise I can keep. All you get with Berkshire, you stick it in your safe deposit box, and then every year you go down and fondle it. You take it out and you fondle it. Then you put it back. And, I mean, there's enormous psychic reward in that. You don't underestimate it. But the real question is whether we can keep retaining dollar bills and turning them into more than a dollar at a decent rate. And that's what we try to do, and Charlie Munger and I have our money in it to do that. That's all we'll get paid for doing. We won't take any options. We won't take any salaries to speak of or anything. We'll ride around in the plane. But that's what we're trying to do. It gets harder all the time. The more money we manage, the harder it is to do that. And we would do way better percentage-wise with Berkshire if it was 1/100th the present size. But it is run for its owners. But it isn't run to give them dividends because so far, every dollar that we've earned and could have paid out, we've turned into more than a dollar. It's worth more than a dollar to keep it. And therefore, it'd be silly to pay it out. Even if everybody was tax-free that owned it, it would have been a mistake to pay dividends at Berkshire because so far the dollar bills retained have turned into more than a dollar. But there's no guarantee that that happens in the future, and at some point the game runs out on that. But it is the goal of, that is what the business is about. Nothing else about the business do we judge ourselves by. We don't judge it by the size of its home office building or anything of the number of people working around it. We've got 12 people at headquarters. We've got 45,000 employees at Berkshire and 12 people at headquarters, 3,500 square feet. And we won't change it. So we will judge ourselves by the performance of the company. And that's the only way we'll get paid. But believe me, it's a lot harder than it used to be.
How do you find them?
It's interesting. I've got a call. I'll be sitting thinking, and different things. In terms of buying private businesses, it's because I get a call from a private seller. But occasionally, I just decide to act, and we never do anything unfriendly. But in terms of buying whole businesses, are
there people who know you and are close to you on the lookout for you, or
not much?
It's
not much.
Unlikely that.
No. Charlie, we've net bought $12 billion of common stocks since the election.
Now,
12 billion of common stock.
it's in my
Equity.
mind which ones I pick. Now, the guys that work with me, the two fellows, they probably bought a little bit or sold a little bit too. But those are ideas that I've either come at it from a different slant in some way or whatever it may be.
Is airlines one of those?
Well, it was shown. I won't tell you anything. We're buying or selling now. It was shown on September 30th that we own some airlines, some stocks.
And so why did you do that?
Well, that I won't get into. But it was in large part my decision.
Well, what's the benefit of being an out-of-towner as opposed to being in Wall Street? I worked in Wall Street for a couple of years, and I like. I've got my best friends actually, and I'm on both coasts, and I like seeing them, and I get ideas when I go there. But the best way to think about investments is to be in a room with no one else and just think. And if that doesn't work, nothing else is going to work. And the disadvantage of being in any kind of a market-type environment in Wall Street would be the extreme is that you get overstimulated. You think you have to do something every day. I mean, the Canver family paid $2,000 for this company, and you don't have to do much else if you pick one of those. And the trick then is not to do anything else, even not to sell it in 1919, which the family did later on. So what you're looking for is some way to get one good idea a year, and then write it to its full potential. And that's very hard to do in an environment where people are shouting prices back and forth every 5 minutes and shoving reports under your nose and all that. Because Wall Street makes its money on activity. You make your money on inactivity. I mean, if everybody in this room trades their portfolio around every day with every other person, you're all going to end up broke, and the intermediary is going to end up with all the money. On the other hand, if you all own stock in a group of average businesses and just sit here for the next 50 years, you'll end up with a fair amount of money, and your broker will be broke. So his activity he's like a doctor who gets paid on how often he gets you to change pills. I mean, basically. If he gives you one pill and it cures you the rest of your life, he's got one sale, one transaction, and that's it. But if he can convince you that changing pills every day is the way to great health, it'll be great for him and the prescriptionists, and you'll be out a lot of money, and you won't be any healthier. You'll be a lot worse off financially. So you want to stay away from any environment that stimulates activity, and Wall Street would have the effect of doing that. I used when I went out to Omaha, I'd go back about once every 6 months, and I'd go back with a whole list of things I wanted to check out one way or another, companies I wanted to see, and I would get my money's worth out of those trips. But then I'd go back to Omaha and think about it.
I'm Adam Berkman with Sterling Capital in Virginia Beach, Virginia. Earlier today, Mr. Munger commented on the valuation of China versus the U.S. market. My question for you is, are market cap to GDP and cyclically adjusted PE still valid ways to consider market valuation, and how do those influence Berkshire's investment decisions? Thank you.
Charlie, I think, I guess Charlie's overall value in China. I would say that both of the standards you mentioned are not paramount at all in our valuation of securities. It's harder. People are always looking for a formula. And there is an ultimate formula, but the trouble is you don't know what to stick in for the variables in it. But that's the value of anything being the present value of all the cash it's ever going to distribute. But the PE ratios, every number has some degree of meaning, means more sometimes than others. Evaluation of a business is, it's not reducible to any formula where you can actually put in the variables perfectly. And both of the things that you mentioned get bandied around a lot. It's not that they're unimportant, but sometimes they can be very important. Sometimes they can be almost totally unimportant. It's not quite as simple as having one or two formulas and then saying the market is undervalued or overvalued, or a company is undervalued or overvalued. The most important thing is future interest rates. And, and people frequently plug in the current interest rate saying that's the best they can do. After all, it does reflect a market's judgment. And, the 30-year bond should tell you what people who are willing to put out money for 30 years and have no risk of dollar gain or dollar loss at the end of the 30-year period, what better figure can you come up with? I'm not sure I can come up with a better figure, but that doesn't mean I want to use the current figure either. So I would say that I think Charlie's answer will be that he does not come up with China versus the U.S. market based on what you've mentioned as yardsticks. But no, Charlie, you tell him.
All I meant was that I said before that the first rule of fishing is to fish where the fish are, is that a good fisherman can find more fish in China if fish is the stock market. That's all I meant.
Yeah. I'm going to go back.
It's a happier hunting ground.
This doesn't really directly relate to this. I want to go back to one question that was mentioned earlier. I really think if you want to be a good evaluator of businesses, an investor, you really ought to figure out a way without too much personal damage to run a lousy business for a while. I think you learn a whole lot more about business by actually struggling with a terrible business for a couple of years than you learn by getting into a very good one where the business itself is so good that you can't mess it up. I don't know whether Charlie has a view on that or not, but it was a big part of our learning experience, and I think a bigger part in the sense than being involved with good businesses was actually being involved in some bad businesses and just seeing
how awful it was.
How awful it is, and how little you can do about it, and how IQ does not solve the problem, and a whole bunch of things. It's a useful experience, but I wouldn't advise too much of it. What do you think so, Charlie?
It was very useful to us. There's nothing like personal, painful experience if you want to learn. And we certainly had our share of it.
Yeah.